Many people face unexpected financial challenges, like a sudden car repair or a medical bill, leaving them in urgent need of cash. For those with limited savings or poor credit, traditional banking options like a personal loan might not be available. They often find themselves at a crossroads, needing money quickly but with few places to turn. The urgency of the situation makes them vulnerable, as they need a solution right now, not next week. In this moment of desperation, a particular type of loan often appears as a seemingly simple answer: the payday loan. Payday loan lenders are typically storefront businesses or online platforms promising fast money with minimal hassle. These are small, short-term, unsecured loans, often due on the borrower's next payday, usually within 2 to 4 weeks. The concept is straightforward. You borrow a small amount of money, typically a few $100s, against your future earnings. The application process is designed to be quick and easy, often requiring little more than proof of income and a bank account. In exchange for the loan, borrowers typically provide a post-dated check or authorize a direct debit for the loan amount plus fees. Receiving the money feels like a huge relief, solving the immediate crisis and easing the burden for a short time. However, the true cost of this quick fix often lies hidden within the terms and conditions. Instead of traditional interest rates, payday lenders charge a flat fee for every $100 borrowed, for example, $15 to $20. While this fee might seem small at first, when calculated as an annual percentage rate, or APR, it reveals a shocking truth. Payday loan APRs can range from 300% to over 700%, vastly exceeding those of credit cards or bank loans. The problem arises on the due date. For many borrowers, their financial situation hasn't improved much in 2 weeks. They find they still don't have enough money to cover the original loan amount plus the hefty fees. Faced with default, borrowers are often offered a rollover option, which sounds like a solution. This means paying another fee to extend the loan for another 2 weeks without reducing the principal amount owed. And just like that, the borrower is caught in a vicious cycle, often called the debt trap. With each rollover, new fees are added, quickly accumulating and often exceeding the original amount borrowed. Many individuals end up paying several times the initial loan amount in fees, yet still owe the principal. This cycle is not accidental. It's a fundamental part of the payday loan business model. Payday lenders specifically target individuals who are already financially vulnerable and have limited access to conventional credit. Their profits largely depend on repeat borrowers, those who cannot repay the initial loan and are forced to roll it over. They present themselves as an emergency solution, but their practices often exacerbate rather than alleviate financial hardship. This effectively transforms poverty into a profitable business model, trapping borrowers in a cycle of debt. The impact on individuals and families can be devastating, leading to increased stress, missed bill payments, and even bankruptcy. Beyond individuals, these loans drain wealth from entire communities, hindering economic stability and growth. Recognizing the predatory nature, many states and federal agencies have attempted to regulate the payday loan industry. Regulators aim to balance consumer protection with the need for access to credit, even for those with limited options. Some regulations include interest rate caps, limits on rollovers, and mandates for clearer disclosure of loan terms. Advocacy groups continue to push for stronger consumer protections and more accessible, ethical financial alternatives. One key alternative is building an emergency fund, even a small one, to cover unexpected expenses. Credit unions often offer small, short-term loans with much lower interest rates and more flexible repayment terms. Community assistance programs, nonprofits, and faith-based organizations can also provide help or guidance during financial crises. Improving financial literacy is crucial, empowering individuals to make informed decisions and avoid predatory loans. The focus should shift from quick, costly fixes to fostering long-term financial stability and sustainable solutions. Ultimately, the rise of payday loans highlights a critical need for financial systems that genuinely support rather than exploit those in need. Understanding this model is the first step towards advocating for fairer practices and building a more equitable financial landscape for everyone.